Let's look at the drawbacks, the disadvantages of venture capital impact investing. So while venture capital impact investing offers several benefits, it also has notable disadvantages that investors should consider. And so here are some of the key drawbacks that are important we take into consideration. Number one is high risk of failure. High risk of failure. So early stage startups are inherently risky with a significant chance of failure. In fact, a high percentage of them do not make it. So this can result in a total loss of investment capital. And so is not for investors who are highly risk averse. It's for those who are willing to consider the risks involved and are willing to take it. Number two is illiquidity. Venture capital investments are typically illiquid, meaning capital is tied up for years, for a long time, with returns only realized after a successful exit, such as through acquisition, maybe through merger, and probably through an initial public offering. So for as long as it will take the company to be able to come to the market, by means of an IPO, then your investment will remain illiquid. You will not be able to cash out. That's a typical, disadvantage of venture capital impact investing. Number three is long time horizon. Long time horizon. Venture capital investment often requires a long time commitment, like let's say 5 to 10 years or more, which may not be suitable for investors who are seeking quicker returns. It's not for people with a short time mindset. It's for those who are willing to be committed for the long run. Number four is challenges in impact measurements. These are challenges when it comes to how to manage or how to really measure, quantify impact. And so tracking social or environmental impact in early stage companies can be difficult with varying standards and metrics, and making it hard to consistently assess impact outcomes. It's difficult to really track or to determine the impact so far, the impact achieved so far. Number five is pressure for high returns. The high risk, high reward nature of venture capital may sometimes put firms to prioritize financial returns over impact goals, potentially diluting or deviating from the initial mission of the company. In a case where the investors become impatient, they want to have financial outcome, profits from their investments. That may, incentivize them to veer off the initial goal of creating impacts, and then they may go into almost like a purely for profits venture or undertaking. Number six is limited influence. While venture capital firms offer mentorship, individual investors generally have limited control over daily operations and may struggle to ensure alignment with impact objectives. As an individual investor, you may not be able to have any level of tangible control over your investments. Is next to impossible. It's virtually impossible. So in that case, you have your influence is limited. Your input may not even be considered. So this is a factor one should really consider, particularly if you want to be hands-on as far as investment is concerned. You may not have that opportunity when it comes to venture capital impact investing. Number 7 is costly management and fees. Costly management and fees. We need to understand that venture capital funds often have high management and performance fees, which can reduce the net returns at the end of the day, especially if the impact objectives slow down financial growth. So they charge, a high level of fees compared to traditional investing. And these fees, have this tendency of eating into one's eventual returns at the end of the day. So you must consider the fact that the fees are always there and they're generally high. Please subscribe to this channel and like this video. Number 8 is risk of greenwashing. Risk of greenwashing. Some startups may overstate or misrepresent their social or environmental impact to attract funding, making it essential for investors to conduct rigorous due diligence. Is always a possibility. Those at the very bottom entering data that has to do with impact may be tempted to exaggerate, the accomplishment, the achievements, so as to be able to attract further funding. Because generally, what brings an increased level of funding is the reports they submit, and that report could be altered, could be doctored to reflect what is not actually the reality. There's that risk of greenwashing. This particular concept is called greenwashing. Number 9 is market competition. As impact investing gains popularity, competition for high quality impact startups can drive up valuation and reduce the potentials for return. It's kind of an attractive sector, an attractive segment, an attractive strategy. And as it attracts newcomers, because there's virtually no barrier to entry as such, then it will lead to both it might impact both financial and impact performance. And these disadvantages highlight the need for careful consideration and due diligence in venture capital impact investing to balance both financial goals as well as impact missions.